Well, as we think about the increasing number of workers having to dip into their retirement savings at a time when some pundits think they should not, I'm often reminded that whether we dip into our 401ks and IRAs sooner or later, we will have to deal with the debt owed to Uncle Sam. Those taxes, if you will, that are for years have been postponed while we were working, but now that we are in retirement, those taxes or that debt comes due. Problem is, these taxes are unknown, having a huge rippling effect on cash flow, and for the most part, these taxes get passed off to our kids when we die. All the while, most of you think there is nothing you can do to reduce the size of what I call your tax tumor, and so what do? Well, most of you do nothing. And now that we have uncovered the biggest debt for most savers in retirement, the debt of all the taxes they will have to pay when they go dragging money out of these 401k plans, we must also remind you that with this debt comes the complexity of trying to understand the rippling effects of tax brackets, that's right, I said brackets, on distributions taken from your 401k and how much it will impact your retirement cash flow. So let's take a look at these 3 tax brackets that you're going to have to deal with. The first is, as we've talked most often about on this show, called the federal income tax bracket. And as we like to say with this tax bracket, like all tax brackets, it gets pretty bad, but basically the more you make, the more they take. In fact, when you put in federal and state tax brackets, this can be as high as 40% of everything that comes out of that tax-infested 401k or IRA. The second tax bracket most people don't think about at all is what I call the Social Security tax bracket. Now, what happens here is, in theory, Social Security should not be taxed, but when you lay on taxable income on top of that Social Security, as much as 85% of it has to be put on the tax return. Now, that doesn't mean you pay 85% in taxes, but again, for some people, that extra income that has to be taxed for Social Security can have a sure rippling effect on their cash flow. And finally, most people don't know about this. I call this the Medicare tax bracket, or what the politicians call the Income-Related Monthly Adjustment Amount, or IRMAA for short, which essentially is an extra tax on Medicare Part B and Medicare Part D premiums. It's really a surcharge that will affect anyone making more and more money in retirement. And where does IRMAA come into play in many of these cases? Well, that's right. When you try to take money out of the 401k to live on. Not only will you pay taxes on the money for the feds and also Social Security taxes, potentially you'll also have to deal with increased Medicare premiums, or what they call IRMAA. So, what is the solution to enjoying more of your hard-earned savings? Well, first off, if you are years away from retirement, be sure that you do not put all of your money into pre-tax retirement accounts, but rather you need to balance out those monies and those contributions going into what we call either after-tax accounts, tax-deferred accounts, or tax-free accounts. This way, you balance out your cash flow in retirement and hopefully keep these rippling taxes of the 3 tax brackets more to a minimum. I mean, why would you defer taxes into the future knowing all the while you're going to have to pay this debt at some point, and you never know, the taxes could even be higher in the future. Second, you can get with someone like us at Tony Walker Financial and figure out how to balance the cash flow now as opposed to sitting around doing nothing in hopes that Uncle Sam will magically reduce the taxes you will owe in the future, which more than likely they're not going to do that. In other words, if taxes in the future go up, so will the debt owed on your pre-tax retirement accounts. It really is a lose-lose situation to sit there and do nothing. So how can you deal with this tax tumor? Well, first thing you can do is chip away at the debt Uncle Sam is wanting it repaid to. And the way we do that is we focus on a specific situation for our clients or prospective clients. In fact, we can create a plan that is tailored to your specific hopes, dreams, and of course, your wallet. And to get started finding out how we at Tony Walker Financial can help mitigate or reduce that tax tumor, we call it the free 10-minute fiduciary phone call, where you and I will talk for a few minutes by phone, and if it looks like we can be of help, that's right, you're going to meet with the owner of the company to discuss your situation, and not only are we just going to discuss it, we're going to lay out a free proprietary game plan, something no other advisory firm has. This game plan is going to help you understand not only cash flow, but how we might reduce those taxes. So take advantage of this free phone call. Just log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com, or give us a call anytime at 877-499-9255.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.